Hello, this is Coach Mike from WinningStockCoach.com. Gonna go over a bit of this week's market overview in this video. Gonna start out with our weekly chart of the SPX, which is the S&P 500. And what you see is, yet again, 1, 2, 3, 4, 5 weeks of consolidation. Now, if you followed my other videos, you'll understand why this channel's here, and you see some price wicks and whatnot above and below. We based these channels before in previous videos off of a mountain chart and just the closing prices. And this was our only peak above this channel. So that's where those lines are, and I've been keeping those lines available there. Last week when the market closed here, we put a couple price projections up as to where we may see indices fall to. And, we came down, tapped just above that 1839.97, and on Friday actually made a decent bounce from that level. So here on our weekly chart, we see that, and I've got it on just a couple years worth, and normally I do the 5-year. I wanted to be able to point out that we're actually kind of at the point, and you'll see where some of these other lines come on here in a few minutes when I get to the daily chart, but where this next week is either going to be extremely boring and flat, or it's going to break above, i.e. a breakout, or below, a breakdown of a couple potential channels. Let's go back to our 5-year weekly, and you can see basically since 2009, that's where this channel comes from. And because it's a 5-year weekly, it no longer shows the first week of March 2009, which was when the market bottomed, and that's where our channel, longer term channel, comes from. This channel you see coming in here, the yellowy color, this begins with the introduction of QE2, and the pink is the introduction of QE3. The one that's currently being tapered from, or we're seeing a reduction in the quantitative easing, the stimulus being pumped into the bond market. Switching over to a daily chart, you'll see that heading into the week, the expectations of a down week in the market with an expected price, a target price around 1839.97, and of course, the low was 1842.11. When you're talking 1840, being off by 2's not too bad. So, I'll take that as a progression. And now we're really left with two things. I would have really preferred Friday not closed with this large upper wick. The type of pattern you're seeing here, Wednesday, Thursday, and Friday, this is commonly known as a morning star pattern. And the morning star pattern can be an actual very bullish pattern so long as you don't fail the low created from the middle of the 3-star pattern. If this were to hold and we were to remain bullish, we might expect to target in the short term 1886.51. But as you can see, just running a little trend line and connecting these tops here, we run the potential of still only hitting this top and pulling back from it. So for a bullish outlook, what we'd really be looking for is continuation that breaks above the line and charges towards that target of 1886.51. And that would be what I would say is probably the best case scenario for the bullish side this upcoming week. The best case scenario for a bearish opportunity would actually be to come up, hit into this line that's connecting our tops here, and begin to pull back from it, because that would give you an opportunity to exit some long positions. And then expecting, just like in last week's video, if you remember, said I expected it to hit here, come up and make a lower high, and possibly fall down into this area. Now, it still has to fail that 1839.97 for there to be really any, I won't even say fear, any confirmation of that move. But it's still one that I'm watching closely because of the particular chart pattern we have. Remember, we've basically just been in consolidation. Little double top and triple bottom pattern. And really, this type of chart pattern, if you look here from what's been created from the 3rd of March, and really, well, now you'd have to say the entire month of March, it's a M-like pattern. And the M pattern can become extremely bearish when you fail the center of that M. A lot of people talk about the W pattern. You see one here, a bullish pattern. And usually when you exceed the center of the W, things get very bullish, and you usually get longer continuation of a bullish move. And on this type of pattern, it's inverse, the inverse of the W, the M, you could get an overdrawn continuation of a bearish move, which would actually be reasonable. If we could come down and touch into a projected channel, run parallel to the tops created from these tops, it could put us right in around that time, the second, third week of April, where we could expect to hit this 1771.05 target on the S&P 500. We're going to move now over to the DJI, the Dow Jones Industrial Average chart. And what we see here is a bit of a double top created a couple weeks ago. And on the subsequent move, we actually so far have created a lower high than the high that was created on March 7th. So long as that high is not broken, that high of 16,466.04, we would assume that a pullback could lead us to here at 16,007.33. And if we were going to remain bullish on this chart, at this point in time, you see the horizontal channel that I basically have marked here, these pink or purple lines, however they appear to you. The heavy volume, the real solid trade probability would come on a breakout or breakdown of these points. Now, if you have a bearish outlook, you're probably going to want to go short as the Dow Jones Industrial approaches or is coming off of this top horizontal line. And if you're wanting to go long, you're going to want that opportunity down around this bottom line. Or otherwise, if you can't get either of those opportunities, you wait for the breakdown or breakout above the consolidation channel that's been created. Now, as far as the DJI goes in general, this particular pattern here is really kind of leaving you in a bit of a standstill. In fact, for one that's smart enough not to really care about what goes on during each day, and maybe even not each day, the markets are designed to not allow short-term traders to make money. That's just a fact. And, the only people I know that lost money in 2013 were short-term traders. So when you look at what is created here, if you are short-term trading and you're wanting to momentum trade, you're aware of the particular pattern and the need for the breakout for the high influx of new volume, and you're also aware of the resistance point that would make right now at the current price your risk to reward not really one that's favorable. That's one thing to understand, that when you are trading or investing in general, a proper analysis of a risk to reward is essential for managing your capital. Capital preservation should be your number one goal. Now, you could say, well, I can preserve all my capital. I'll never invest, never trade, and I'll never lose money in the stock market. You're right, you'll never make money in the stock market. Managing that risk and understanding the difference between a trade that could make money and a trade that's more probable to make a lot of money are completely different things. And it's actually something that novice traders really struggle with. They'll see a chart that's kind of on the move. They wait, they hit the button at the wrong time, and they end up buying at the high, and it falls. That's what happens in consolidation pattern. Even though you may get a lower price on a long trade for an entry here, the probability of a better trade comes on either the bounce of this bottom line or the breakout from the top line where new highs would be created. And that's what you want to look for. And overall, in general, you also want to key in on the indices for your associated charts in the indice they trade in accordance with. Because understanding the indice helps you understand, why did my stock go down today? There was no bad news. There's nothing going on with my stock. But then you look over at the S&P 500, you look at the Russell 2000, you look at the Dow Jones Industrial, and you see that they had a bad day and it drug your stock down with them. So these are all things to understand, and an understanding of the indices allows you to understand your stock a lot better. Now we'll go ahead and look over now at the Russell 2000. If you remember last week, I said for this to remain bullish, it has a lot of work to do, and it didn't do any of it. And look at that drop target I gave. If you remember, I said we need to watch for 1151.44. Granted, it put a wee little wick on Thursday below it. And it pretty much closed right at it on Friday, 1151.81. When you're talking $1,150, I think being less than 40 cents off is acceptable. And if you remember in last week's video, what did we talk about for what we would project? Now let's look at this. And I still have my exact lines from last week. And we said so long as it held the 1171.87, this could actually bounce up to a new high of 1219.93. We now have to take that line out. That line is gone. Why is it gone? It's gone because a new low was made. Look at this. We have a high, a low, a lower high, and now a lower low. Should this thing bounce in the upcoming week, we could use our Fibonacci extension tool. We could connect the low, the high, and then this new low that was just made in relation to the last move and give us a projection of where a bounce could lead us to. And if we did bounce from here, we would project to see 1183.09. Now understand what this means for the small cap market. If you do get the bounce here, you see the Russell 2000, the RUT, the small cap index, get into this 1183.09 and begin to pull back from it. That'd be your confirmation of a third lower high, and it would be time to exit long trades. You could use the indice to assist your trading overall and to understand why your stock might move in a direction opposite to what you hoped it would when you bought it, and understand that the stock's beta rating and where the indices are trading at will have a lot to do with your stock's movement, shy of any news related earnings, new product, big deal news comes out. That can shift things slightly, but on the average day you don't have that news. So on the average day you have to trust your indices and trust the trading on them overall. And as you can see, even though the price dipped a little bit below, for our close on Friday, we were less than 40 cents off our target. And I think what that is implying to me personally is that on a subsequent bounce now, I need to look at that as an opportunity to exit small caps that I might be in. And I think that's the best advice to put out there to anybody else. The Russell 2000, all through 2013 and early 2014, has commonly been a precursor indicator to what we see on the DJI and the SPX, which is actually somewhat odd in comparison to the historic value of the leading and lagging charts as indicators for our indices. But we also have to take into consideration what has been fact, which has been the RUT leading. And to see the RUT begin to make the lower highs and lower lows, which, based on the chart I'm looking at, and you're looking at with me, it'd be impossible to debate the fact that we are making lower highs and lower lows now. And it just leads me to that belief where, though it may not mean the market's going to crash, it at least means we more than likely will find better buying opportunities, more in conjunction with a trend line like this, where we have retracement points to already, and that we may just be better off waiting for those types of opportunities. I'm going to take a look now at another indicator for another chart. It's the SPY chart, the SPY, which is the Spider ETF for the S&P 500. So it trades fairly well in conjunction with the SPX chart. Now, this indicator you're seeing over to the right-hand side of my chart is basically a volume by price indicator. It shows you, based on different price level, the extent of the volume traded. These bars, based on their length or lack thereof, serve as support, resistance, and also areas you would just expect to cleanly blow right through. Now, I want to show this as an area of importance. You see that from our current price, we got some lower volume, and we start to build right just where we bounced from, with these two real thick bars right over in here. Because of the heavy volume levels traded at those price ranges, it's given us quite a decent level of support at those price areas. Now, what you'd also have to realize by looking at this indicator is, though it's a very healthy support level supported by the volume, if these prices right here, if Thursday's low, this past Thursday's low, were to fail, we don't get real thick, helpful volume until we get down into the 179 area, which would be, 1790s, 1780s on the S&P 500, and would probably put us more in conjunction with this trend line that you see on our 1 year daily chart, catching a few bottoms already, and would actually be the area we would hope to pull back to. Now, understand that in uptrends, you see an uptrend here, well, there's a red candle. There's a red candle, another red candle, red candle, red candle. Here's a big red candle. Here's 3 red candles, couple red candles, a few more red candles, red candle, 5 red candles, all of which contained in an uptrend. In a downtrend, you had green candle, green candle, green candle, a few more green candles. You come in the downtrend, you get a few green candles. What I'm pointing out with this is a green candle in a downtrend means nothing. It just means that day was a green candle. So we really need to focus and monitor that downtrend line from the SPX on our daily chart that connected through those tops, and monitor to see if that line is broken for a bullish confirmation, or if Thursday's low on the S&P 500 of 1842.11 and even this 1839.97 is failed for a bearish confirmation, and anything in between, quite frankly, is increased risk. This is Coach Mike from WinningStockCoach.com, encouraging you to join us in our premium chat room as a member of the Coaches roster. Best of luck to you in your trading this week and all weeks upcoming, and God bless.